Good afternoon, everybody. Thank you for joining us here today for Bonds 101, What to Know Before Investing. My name is Chuck Mattiucci, Senior Vice President and Financial Advisor here with Fort Pitt Capital Group. I am joined by my colleague, Roman Day. We also have another guest who will be joining us a little bit later, Jay Samariva, who is our Director of Asset Management, will be joining us to field some of the questions that we accumulated prior to doing this webinar. Jay has an extensive background in fixed income, not just with Fort Pitt, but also with previous employers. So Jay's a wealth of knowledge, and we look forward to having him join us a little bit later. So before we jump into everything, just wanted to take a couple of minutes to talk a little bit about some of the uniquenesses here at Fort Pitt Capital Group. For some of you that may not be clients or may not be familiar with our firm, but some key points, something that we really pride ourselves on is our in-house investment management. So we do have a full service investment management team that essentially chooses all the investments that we use for our clients, monitors those investments, and makes changes when appropriate. We can really customize a portfolio for a client. We're doing all that in-house and not farming it out to a third party. So that's something that really separates us from a lot of our competitors. Something else that's really important to us is, although we have all of the resources of a much larger firm, we've always had a culture of really trying to keep that smaller boutique type feel. That's always been important to us, and always will be moving forward, to really have all the resources that you can get anywhere else, but have that personal, smaller kind of boutique feel. And last but not least, although returns and the amount of money that we make for our clients is very important, and the advice that we provide is very important, but we also think that doesn't happen without excellent client service. We've always really been committed to the highest level of client service, whether it's dealing with one of our financial advisors like myself or Roman, or one of our teammates. That's very important to us, and we really strive to deliver that highest level that we can. So a little bit about myself. I actually have been with Fort Pitt Capital Group for about 8 years. I've been an advisor for going on 16 years. My kind of I guess goal with all of my clients is to really just be that financial quarterback for all of my clients. I want to be the one source that my clients come to for any type of financial question or concern, and ensuring that we're doing everything that we can to help you reach your long-term goals. That it's really kind of driven based off of the financial plan that we put together initially. Outside of work, what keeps me busy, I have 3 daughters, so that's probably saying enough right there. That keeps me very busy. 3 young daughters, they're involved in a bunch of activities, and love spending time with them. Also love spending time with friends and family. Rarely get to do it, but love to play golf and just spend time outdoors.
Thanks, Chuck. Yeah, my name is Roman Day. I'm an advisor here with Fort Pitt Capital as well. And as an advisor, I mean, similar to what Chuck said there, our goal and my goal is to help navigate folks to their goals in and through retirement. We hope to be financial quarterbacks, your household CFO, and ultimately build comprehensive financial plans that take into consideration the many complexities that folks have going on in their financial lives, bring it all under one picture, make sure there's a cohesive plan to navigate the waters ahead in and through retirement. Outside of work, wife and I are involved in our church community, love the outdoors, like to golf, and actually have our first little one on the way as well. So I'd imagine that'll be the majority of what we're doing outside of work here for the foreseeable future. But thanks again for joining us all here today. Want to walk you through how to interact. We encourage that. We hope that it can be as much of the discussion as possible. If you're joining us today on a device, you can tap your screen to ask questions or get the handout as we move through the slides. Additionally, if you are on a conventional computer, you should have the Q&A dialog box that'll pop up, and there's a little Q&A with a question mark dialog prompt right in the middle of your screen. So at any time, please chime in with questions, and we'll answer those either as they come up and as well as our Q&A session at the end.
Great, thanks, Roman. So before we kind of dive into all of the slides and the content, I did want to just take a second and mention, why we decided to have this webinar today on this particular topic. Bonds may not be the most interesting investment to folks out there, but it is an important topic. Clients of ours who have been clients long term know that we have an affinity here at Fort Pitt Capital Group for stocks or equities based on what we call the equity premium. And the equity premium is essentially just the higher long-term returns that you can expect from stocks or equities as an investor. That being said, if you've been a client for a while, either you have some bonds in your portfolio or you've heard us talk about incorporating bonds into your portfolio. Bonds do have a place and an important place in portfolios, especially at certain stages. The stage that we probably see the most here, and the time when we probably initially end up incorporating bonds into a client's portfolio, is when a client moves from what we like to call the accumulation phase into the consumption phase. We also kind of use the analogy of that's essentially the time where you stop getting a paycheck from your employer and you start getting a paycheck from your portfolio. That's pretty much the most common time where you would see us incorporating bonds into a portfolio, although there are other situations where it may be necessary.
Yeah, but what we're here to look at today too is so why does that transition to retirement and the need of regular income from portfolios tend to warrant an allocation to bonds? That's something that we plan to explore here today as well. And while, as Chuck mentioned earlier, our investment philosophy points strongly to stocks, and that's where a lot of our conviction is, basically up to the point of retirement for most clients. What we do is we take an approach where we'll look, typically about 3 to 5 years, or a couple of years ahead of retirement. We'll look at a client's projected income needs. So we look at your Social Security, which generally Social Security and pension heading into retirement, and your current lifestyle and cost of living associated with that, as well as the lifestyle you hope to maintain in and through retirement. And that need in between, we can fund from your portfolio. And what we'll do is we'll use some stocks and bonds to create that, but we use bonds to build that initial allocation. We want to have 3 to 5 years in bonds and cash heading into retirement. And Chuck and Jay will elaborate more on why that's our methodology here moving forward. But just as an example, if a client needs $75,000 on an annual basis in income from their portfolio on top of Social Security, on top of a pension, what we would do is we'd want to have between $225,000 and $375,000 in bonds and cash prior to retirement. And this may lead you to ask, so why do we use bonds for this, and why do we look at 3 to 5 years as the timeline?
Yeah, great example, Roman. So the primary reason, that we, I would say the primary reason why we want to incorporate bonds into a portfolio when a client is taking income is we never want to be in a situation where we have to sell stocks when the market is down to raise cash to get a client the income that they need from the portfolio. That's probably the worst scenario that we can be in. So what do we do if a client is needing income and the market's down and we don't want to sell stocks to raise that cash? That's where we have bonds in the portfolio. We can pull the income from the bonds during that period of time when the market's down and allow the stocks to just rebound with the market. That's always been our philosophy as far as allocating bonds to a portfolio when clients are taking income. As far as the 3 to 5 year range, the reason why we pick that target time frame is historically it takes about 18 months to rebound from a recession or a bear market. That's kind of historic, but there have been times where it's taken longer to rebound. So we feel having that 3 to 5 years of income out of the market in bonds and or cash to pull from is a prudent amount of time to allow the portfolio to rebound and continue to get the clients to get the income that they need. So we talked a little bit about kind of what the reasoning is to the impetus to have this webinar today. So let's kind of jump into the meat of the presentation. And I'll be honest about this. Is some of this stuff is very basic, so it may be a little redundant to some of our more sophisticated investors. But I think it's important to just kind of outline, all the aspects of a bond of bonds and the terminology, and then we'll talk a little bit more about some of the more detailed aspects. So just starting, with the most general question, what is a bond? A bond is essentially a debt instrument that's issued by different institutions to raise capital for any number of different things. We always talk about there being two main opportunities as an investor. You can either be a business owner or you can be a lender. And essentially what we mean by, being a business owner is owning stocks. You own a piece of a business. As far as being a lender, that's essentially, being a bond holder. You're lending your money to an institution in receipt of an interest payment, that you will get periodically. Down below on the slide, we just have a really basic example. This would be a corporate bond company, ABC, issues $1,000, or excuse me, $1 million worth of corporate bonds on August 1st, 2025, that will pay a 5% annual coupon or interest payment with a maturity date of July 31st, 2023. So this would be like a very common type of corporate bond that we would see, and clients or investors can invest in that bond in increments of $1,000. So moving on to bond terminology, some of the key facts that we think are important would be first, par value or face value. That's essentially just the amount that the bond issue agrees to pay back to the investor or bondholder when that bond matures. And again, as I mentioned a minute ago, they're issued in increments of $1,000. Coupon, that can also be referred to as the interest rate, that is applied to the par value or the face value of the bond, and that is essentially what determines the annual payments that the client would receive from that issue. Maturity date essentially is just the date when the bond holder is set to receive their principal payment back. Market value, this is something that we talk to our clients a lot about, especially investing in individual corporate bonds. Bonds are not different from stocks in the fact that there is a secondary market for bonds. So because there is a secondary market, there has to be a value attached to that bond at any point in time, and that would essentially be what the market value is. This is what another investor would be willing to pay you for that particular bond at a certain point in time. This doesn't really come into play so much for our clients because we do pretty much exclusively hold our bonds to maturity. So as long as we hold that bond until it matures, we're going to get our principal back. Yield to maturity. So this is another term that you maybe have heard of. So yield to maturity takes into account if a bond is held to maturity, what the yield would be, but also factoring in the price paid for the bond. So if a bond is bought at a discount of where it was issued, you can factor in yield to maturity based off of those factors. And then last but not least would be a callable bond. So a callable bond is just essentially a bond that can be redeemed by the issuer before the maturity date. So in the example we used in the last slide, that bond was set to mature in July of 2030, but it may have a call feature that allows it to be called starting in July of 2027. So moving on to the next topic here, we're going to talk a little bit about the different types of bond issuers. So there's three main types of bond issuers that we'll talk about here today: governments and municipalities, agencies, and corporate bonds. So starting with government bonds, you can see here on this slide the three main types of U.S. treasuries that we're showing here: T-bills or treasury bills, treasury notes, and treasury bonds. So the main difference in those three is essentially the maturity schedule for them. T-bills being the shortest. T-bills essentially mature within 2 years. Treasury notes within 2 to 10 years, and then treasury bonds are 10 years and longer. The key factor with got these U.S. Treasury bonds is that they are backed by the full faith and credit of the United States government. So they are, for the most part, kind of considered the gold standard, or safest, less, most less risk when investing in bonds. The next type of issuers that we'll talk about are municipalities. So you may have heard of muni bonds, as they're referred to. These are essentially issued by different municipalities, local and state governments, to fund different projects. Remodeling a school, adding an addition to a school. A school district may issue a bond to do that. If your local municipality wants to is redoing a highway, they may issue a bond to do that, or adding onto the sewer system or something like that. These are all different projects that can be funded through municipal bonds. Municipal bonds are also generally considered to be less risky than, say, like a corporate bond. However, there is the potential for default, when it comes to municipal bonds. Here at Fort Pitt, we are always focused on, the highest quality bonds, and dealing with bond issuers who, have a really strong track record. We're really meticulous about, choosing who we will invest in when it comes to municipalities. Next is agency bonds. So you won't see this too much with us here investing in agency bonds, but we did think it was important to just kind of mention. You may have heard of Fannie Mae, Freddie Mac, the federal home loan banks. Those are government agencies that do issue bonds, and then also Ginnie Mae as well. The key distinction here would be that Ginnie Mae's are the only one out of the agencies that are actually backed by the U.S. government. As mentioned earlier, the tax treatment with these different types of bonds differs pertaining to that type of bond, but we'll get into that here in a few slides. Last but not least would be corporate bonds. So just like the name states, corporate bonds are issued by corporations to raise capital for any number of different things that a corporation would want to do, whether they want to improve their infrastructure, build a distribution facility, hire more employees, whatever the case may be. Corporations can raise capital by issuing bonds. Some of the key things to remember here about corporate bonds is, the risk on when it comes to corporate bonds is a little bit different than the risk related to municipal or government bonds. The risk tends to be a little higher in corporate bonds because it is essentially based on the financial health of a particular company. As I mentioned earlier, when talking about government bonds and muni bonds, we are very picky with the types of corporations that will invest in as far as their debt. We really focus on only highly rated issuers with a strong track record. It's also important to mention that there are a couple of other different types of risk that come into play. Interest rate risk, default risk, a little bit more than what you would have with government or muni bonds. We're going to talk about that here on the next slide.
Yeah, typically, as Chuck alluded to as well, within a fixed income allocation in a portfolio, we tend to use bonds, and bonds are generally regarded as a more conservative allocation within a portfolio. But as is the case with any investable asset, they're not without certain degrees of risk. And we have a couple categories here, and really the two main factors, which are default risk and downgrade risk. The first, as implied in the name, is the risk of default by the issuing body. Let's say a corporation. The default risk is that company would be insolvent, first and foremost, to go bankrupt, or not be able to meet or pay some of those coupons or interest payments on the bond itself. As we'll look at here in the following slides, there are ratings that denote both essentially a company's credit score, for lack of a better term, or the rating on a certain bond. So as we can see here, we have Moody's and S&P and Fitch, which use the same one. It's a lot of terminology that is trying to convey the same message, that there are degrees and there is relative safety within certain bonds. So we have AAA, AA, and the investment grade, which really the floor of that would be BBB. We would probably make the argument that AA, or at the very least A+ is where you'd like to be within a portfolio, if not higher. And then you have speculative or high yield, sometimes referred to as junk bonds, that fall below that threshold. And the idea is that as you go further down into the C's, BBs, C's, even D bonds, that there would be a higher yield available for that risk. So a company does not have a long track record of being able to pay on time, or they don't have significant financials or financial statements. That's what these rating agencies are in theory going and examining and giving the investor some insight as to the relative safety of their investment within bonds. Now we're gonna pivot here to talk about generating income from bonds, what that looks like within a portfolio. Obviously, when we talk about bonds, that's within a fixed income allocation in a portfolio. When we talk about fixed income, there are really two things that are fixed about it. Within a bond, it's a fixed period of time, as Chuck defined earlier, maturity, and then a fixed interest or coupon payment. So you can think of a 10-year treasury. It's for 10 years, and maybe it's $1,000 treasury, so you're going to pay $1,000 today if bought at par value, or $1,000 in 10 years, and then you're going to receive a 5% annual coupon between when you bought it and when the bond matures. Capital appreciation is something that we'll discuss. It's really reflected in market value and is not something that we choose to take on frequently within the bond space. We don't believe that fixed income is the place to really swing for home runs within a portfolio, but should be just that, a more conservative allocation. There is the opportunity to see capital appreciation reflected in a bond, which we'll talk about further in the presentation as well, in the way of a premium or a discount relative to the par value of the bond. Now, sometimes we'll see with fluctuations in interest rates that bond may sell for a little more or a little less than it was initially purchased for. And with tax treatment is a way we can be creative in how we structure bonds for an individual client, which we can look at here now, whether we look at municipal, treasury and government, or corporate bonds. Obviously, Chuck broke down the different issuers. And with the different issuers, we have different tax treatment. For municipal, this interest is generally tax-free at the federal level and can be taxable at state or local. Fortunately for fellow Pennsylvania residents here, Pennsylvania muni bonds are exempt from Pennsylvania state income tax, which is a great advantage. And Treasury and government are also generally exempt from state and local taxes, but the interest income would be subject to federal tax. And something before we jump into corporates that we'll look at and compare with that tax treatment is the taxable equivalent yield. So we can look at a municipal bond that may pay less than a corporate and look at that yield adjusted to an individual's tax bracket to see what would be the best return on the investment for that bond. We'll see that corporates here, that interest is generally taxable on bonds. The only exception there would be if it's held in an IRA or 401k, where that interest would not be taxable when it's received, but when those assets are distributed from the IRA or 401k. Bond pricing and bond yields. Obviously, this is the question you hear people talk about with fluctuations in interest rates coming from the Federal Reserve, and how that trickled down to the broader bond market. We call this interest rate sensitivity. There's an inverse relationship between interest rates and bond prices, which is best outlined in our teeter-totter example here, where if you have a bond at, say, 4% and interest rates rise to 5%, that bond, if you were to sell it on the secondary market, would sell for less than its par value at 4%, because now you could buy the same $1,000 bond with a higher coupon rate. And the opposite is true. If you had a bond at 4%, interest rates were to fall to 3%, you could sell that bond on the secondary market for a premium above what you paid. You'd no longer receive those coupon payments as you're no longer the bondholder. But this is something we see reflected in the markets, and often, even talking with clients, we see reflected on statements where the market value may fluctuate, but so long as you buy a bond at $1,000 or par value, you hold it to maturity, you continue to receive those coupon payments regardless of what the market price of that underlying bond is. And the market value does not affect the par value or the coupon payments of the bond. Now, going to pivot here as well before our Q&A and answer a couple of key considerations for what Fort Pitt does within bonds, what our process is, what that looks like. Without further ado, we'll hand back to Chuck.
Yep. So for this part of the presentation, we are going to invite Jay Somariva, Director of Asset Management, into the presentation. As I mentioned, Jay has an extensive background in fixed income and has really kind of, the time that he's been here at Fort Pitt, pretty much ran our bonds and fixed income programs. So we're happy to have Jay join us here. We do have a few questions. We're going to scoot over here so Jay can get in to the screen.
Yep.
Jay,
Process.
there we go.
That's great.
I think we're good. Perfect. Awesome. Jay, thanks for joining us. We appreciate it.
Sure.
So, essentially what we've done so far is just really talking basic about, about bonds, what they are, how they work, and, what maybe types of bonds that we tend to look at in clients' portfolios. I think like the first question maybe that I had for you was, could you talk a little bit more about those types of bonds that we do tend to invest in for our clients?
Sure. I was on the other side of the screen here listening to your presentation, and I think you guys did a great job explaining the nuts and bolts of what we do and how we do it. And what really was important that you highlighted at the beginning is we have an internal research team that is sitting there on the desk, and their job is to research both equities, fixed income, and any other instrument that we decide to look at. And as far as the fixed income products, we have the ability to invest in an array of issuers, be it private credit, be it structured notes. But the nuts and bolts of what we invest in at Fort Pitt is corporates and munis. The majority of our clients are comfortable with those two, and we seem to have a good grasp on what to look for and what to buy in those two areas.
Great. So, as Roman and I kind of talked about earlier, actually Roman kind of mentioned when talking about, I think he mentioned like taxable equivalent yield and things like that, where we'd use muni bonds in certain situations and corporates in certain situations. The one other thing I did want to kind of touch on is primarily what we tend to do here for our clients when we invest in bonds is to build a bond ladder. So can you maybe elaborate a little bit on what is a bond ladder, how does that work, and why do we do that for clients?
Sure. Just on the face of it, a bond ladder would mean, let's say we're going out 5 years. We would do, 2 in the first year, 2 in the second year, 2 in the out, a ladder. That's the basic form of it. How that actually ends up is not that simple. It depends on where we think interest rates are going, where interest rates are now. If we believe interest rates are going to go higher, we'll front load that initial investment with the anticipation of them coming due in a year or two. And then when they do come due, we're able to reinvest them at a higher level, and vice versa. So, basically what the bond ladder is just saying that we're not going to put all of our eggs in one basket.
Right. Yeah, I think that, and we saw that here recently within the past 5 years, right, with interest rates, prior to coming out of COVID, interest rates have been historically low for a really long time. And after that, we saw rates rise pretty quickly. And that type of environment would be the exact type of environment where having a bond ladder really pays off, because as interest rates are going up, we have bonds maturing and we're able to buy in and reinvest it at higher rates, as opposed to, having bonds that, have a really long maturity. And, when interest rates are going up, we're still locked in. We can't take advantage of that. So That's an example I use a lot for my clients because of, recency. It's, when you think of this, we just kind of had this situation happen. So, yeah, absolutely.
Yeah, and talking about building portfolios with custom maturities for clients too, are there life events that we can kind of build maturities around? How does that work?
Yeah, I think this is the most interesting part that I don't realize. I don't know if the clients realize that they have the ability to do this with us. If there's a major event coming, a wedding, um, they're going to buy a house in 3 years. They know that the children are going to be going to college in X amount of years. They let us know we need X amount of dollars in 3 years. We need X amount of dollars in 2 years. So in that case, we won't do the bond ladder. We will talk to the client and figure out exactly the time frame that they need the cash and invest accordingly. So therefore, everything will come due at the time they need the cash available.
Great. Yeah, that's a great option. I think most clients don't know that we're able to do, but by taking a comprehensive approach and building custom portfolios is absolutely something that we can factor in. And Jay, a last question here for you as well. We talked a lot about a number of metrics that go into the bond buying process as well. How would something like a premium or discount factor into what we do here at Fort Pitt?
Yeah, you're right, Roman. There's a lot of moving parts. Again, if just in a perfect world, it would not have an effect, but you have to look at the reasons why something is trading at a discount or a premium. If it's trading at a discount or a premium because of interest rates, that's fine. We'll figure out what we need to do there to make sure that the client gets the amount of cash flow that they need on a yearly basis. If it's trading because of a credit risk, that's a whole other story. There's where we see a lot of portfolios that come in that we're looking at that they may have reached for yield because the company was discounted because they needed the money to keep going. And so we definitely take that into effect. We're not going to do that. We're not going to chase yield because the primary goal is to make sure that the client gets their initial investment back. So yeah, there's a lot of moving parts there, and it has to do with the credit situation as opposed to interest rate situation.
Great. No, that's a good goal. It seems like a common one across the management teams is to get the client's money back and hopefully make some in between as well.
Mm-hmm.
Yeah.
Yeah, and I know, again, kind of just piggybacking off of that, I had a client that I worked with a few years back, and they were actually, self-managing their portfolio, and a lot of it was individual stocks, but then they did have some individual corporate bonds, and unfortunately, they had invested in some corporate bonds in a municipality that did default, and unfortunately, we did the best we could to try to get out of those for the client and kind of fix that. But the reason that happened is because this client was somewhat of a astute advisor or investor, but didn't really know the bond market much and really reached for yield. He went to go invest in these particular bonds because they had a really high coupon, but he neglected to really look and see what the credit quality was. So that's the last thing we ever want to happen for any of our clients. So I know, Jay, you've mentioned it before. We would rather take a little bit less yield on a bond than take risk on something that is paying a little bit more, but maybe comprised as far as the credit quality goes. So
Yep. Yeah, I think Roman may have mentioned it that there are areas that we could take more risk, and that would be in different equities or what have you, but we don't view the fixed income market as the way to do it.
right. Yeah. Well said. No, I agree. I think our job with with the fixed income portion of the portfolio is keeping that consistent, keeping that conservative, getting that client the income that they need from that, and taking taking some bigger swings elsewhere in the portfolio for sure. Okay, great. So that, I think that brings us to the end of the questions, that we had. I think again, this is kind of a topic that we want to talk to our clients about. It's not necessarily the most exciting topic, but it's important. So, hopefully, down the road, we can have more of these and talk a little bit more in depth. Just like a lot of the different investment vehicles we use, they can be somewhat complicated. So this is just kind of really scratching the surface. And we could definitely get into, much more detail down the road. So, more to come on that.
Yeah, I want to thank you all for joining us here today as well and demystifying bonds, and look forward to talk to you here again soon, actually at our upcoming All About Insurance webinar June 11th at noon again. Again, another topic that we're excited to tackle and help guide you through, as well as hopefully shed some light on something that seems to be complex and an area where we do get a lot of questions to clients.
And you're hosting that one as well, right?
Yes, yeah, it would be myself and then Daryl Patton, Senior Advisor here with Fort Pitt as well.
Awesome.
Team, I think there is one question still in the QA section about addressing the pros and cons of owning bonds versus bond ETFs.
Oh, okay. So we got word that there was a question in the queue that we didn't get to. And the question was, what are the pros and cons of owning individual bonds versus bond ETFs or bond funds?
Yeah, I think we touched on that briefly. It comes down to having control of your investments in the time frame that you need to have control of. Buying an ETF, which I'm not opposed to in certain areas, but you don't know if you're going to get your money out at par doing that, because it's going to fluctuate, and there's not a set date that everything matures at one time, because they have so many issues in there. There's always going to be it's either something lower or higher. So if you get into the wrong interest rate environment and you need to pull the investment out, you can be all the income that you made from your coupon could be wiped away on price depreciation. So that is the main difference and the main concern that we have when it comes to investing in fixed income.
Yeah, and one thing that I would add there too, to what Jay said is also it's transparency. Same as like investing in individual stocks as opposed to mutual funds. If you have an individual stock portfolio with us, you see all the companies that you own. Same thing with the individual bonds. You see all the bonds that you own. You know who the issuers are, as opposed to a bond fund or a bond ETF where, I don't know, could be hundreds of bonds bundled in there, and you don't know exactly what all you're invested in. So good. Thanks for taking that one, Jay. Appreciate it. All right. Well, that again brings us to the end here, and we thank you all for joining us. And please keep us in mind and join us for other webinars that we have coming up here in the future. And always reach out to your advisor if you have any specific questions about bonds or anything we talked about today. And if you are a prospective client and interested in getting more information, please reach out, call our office, send us an email. We're happy to talk and give some information. So thank you, everybody, and have a great day.
Thank you.